Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in, take a look, see what people are sharing. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com is where I share my opinions about the markets, individual companies, looking at a bunch of different sectors for potential investment opportunities and entry points. I am a long-term investor. I do not play the short term. I do try to time my entry points as best as I can. And I've got a variety of strategies to play the markets across speculative companies, high growth companies, and high growth dividend payers. I do not invest in companies that are just dividend payers but do not have high growth. I think the dividend payers are every bit as growth oriented as some of these growth companies. And they may even outperform some of the speculative companies because I do look for companies that do share buybacks and other shareholder returns, uh, that they can provide. Mayday coupon is active, and you can use that for a discount if you'd like. So Josh Young says this is what did well the last time the U.S. experienced stagflation from 71 to 1981. Energy equities outperformed during that time frame. That was energy equities. Now, a lot of people look at that and they say 73%. I do not look for companies that are going to perform 73% over a 10-year period. I am looking for 10 baggers, 20 baggers, 30 baggers, 40 baggers. You do have to basically put up with more volatility. And the companies I'm looking at are high growth in the energy space where they can grow their production rapidly. Most of the companies that can grow their production rapidly are high cost producers. And when you can buy these companies where the price of oil is today, you have a large runway for price appreciation. It's not going to be 73% over a 10-year period. Add a zero to it, 730%. Or, I mean, it could be thousands of percents. There's also other equities in the market that are even cheaper in the energy space, in, say, energy service companies and stuff like that, where I think they are completely mispriced. And the value is very good. So I think that we are coming into an era where energy equities could outperform, and there are certain sectors and companies that are vastly undervalued today and have monster growth ahead of them. And their balance sheets are very much leveraged with debt and other things that are providing that leverage. Garrett Goggins says the Fed is determined to not let another 2008 calamity happen again. They will aggressively ease and use their balance sheet to take on any bad debt. Assets will climb higher, but fall in real terms. You think inflation has been bad, you haven't seen anything yet. I'm prepared. Are you? Yeah, I'm completely prepared. The one thing I will say is this is not like 2008. It's not even close. 2008 was a real estate market crash with a bunch of deleveraging. We could have deleveraging, but the banks, the credit creation in the process is 70% against residential real estate. It might even be a little bit higher than that. That is the biggest driver of credit creation and credit destruction. In order for that to be the same, you'd have to have a real estate crash. There is no other sector or combined sectors that can even add up to 70% of the bank's credit creation balance sheet. So residential real estate's the main deal. Commercial real estate, there could be problems and there could be credit destruction in commercial real estate. But I also think that it's not going to be nearly as bad, even if we do have that, because it's not as big of a percentage. We got Geiger Capital here. He says the last two times the Fed's first cut was 50 basis points or greater than was January of 2001 and September of 2007. In 2001, the S&P fell 39% the next 448 days. Unemployment rose another 2.1%, and we got a recession. In 2007, the S&P fell 54%. The next 372 days, unemployment rose another 5.3% and a recession. And that's what everyone and their mom is looking at. And that very well could be the case, and I think it would most closely match 2001 if we do get a recession. That's what it would, I think, mirror the best. The reason I think it would mirror that the best is because I think the real estate market is in the same alignment as that, and I think that the technology stocks are in that same overvalued state. But we might not have a big blowout recession. It could be a soft landing. And I know there's very few people in that camp, but we are fiscally spending quite a bit of money. And the real estate market and the data that we're getting from it doesn't look that bad. It looks like it's responding to the upside. So I'm not in the camp that a big recession is coming even. That might still be in the future, a few years. So we'll see. Grady says the market might need a few days to digest this. They got a 50 point, 0.5 rate cut they wanted. Now we need to see what the market will do with it. Fed mostly follows what the market tells them to do. So also this time, SPX is right up against the all-time high trend line, inflection point. Where are we going to go? Down or higher? And I just did this on the commodities update. Multifamily permits and starts are back on the rise. Did you guys see this? Multifamily permits and starts are back on the rise. They're back on the rise. Okay? What did it do in 2000? 2000, it was going down. Look at 2000. It came down for a little bit, and then it started going back up. We are going back up on both of these. This is multifamily housing completions going up. And then we've turned, and we just started going back up. Now, this is something I'm watching. If this continues to go back up, I find it very difficult and very hard to see a blowout recession. I'm sorry, guys. Like it could be a soft landing, something like that, money shifting around, okay. But if this continues higher, I'm not no recession camp if that goes up, is my opinion. Coming down to Don Durrett says most of the people who will purchase silver don't even know they are going to buy silver. And this is not even 1% of the public on physical silver yet has their precious metals savings. When the price of silver starts to rise, everyone will want to buy silver coins and bars. What happens to the price of silver once that happens? But again, guys, one thing I will say is these are all hypotheticals. It actually has to materialize. So are we going to go into this big crash everyone is talking about? And will people run to physical silver and gold right off the bat? I don't know. That might be a little bit further into the future than what some are thinking. But it's good to position before that. Peter Spinya says, India imports 45.4 million ounces of silver in the month of August. Ed Steer, there's USD 1.316 billion worth of silver, or around 45.4 million troy ounces, which is monstrous and represents 20 days of world silver production. So that month of August, they purchased 45.4 million ounces, and that represents 20 days worth of silver production. That is ridiculous. They almost bought the entire month, India itself. But I do like silver myself too, and you know what? It makes me want to buy some more. It really does. VLCC rates have continued to creep up, and owners are feeling they are now in position to try and push this further. VLCC is the larger tankers. So VLCC is the biggest, I think that's the biggest tanker, or it's one of the bigger tankers, and rates for those have been creeping up. So our tanker stocks that we are invested in and are paying us massive dividends are going to like this increase in VLCC rates. They've been chopping sideways for a little bit. Mortgage demand surged 14% last week. Mortgage demand surged 14% last week. Let me say that again. That is what I've been looking for. So as rates go down, we want to see if mortgage demand goes higher. Give it time. It's going to filter through into housing starts and some of these other areas that I'm looking at. I have never seen a recession when the housing starts have been going up. So if they lower rates and they get it fast enough, which the market has already lowered rates pretty quickly. I want to see what this does with mortgage demand, and this is exactly what we're seeing as a surge. That's a good thing. This is not a 2008 cycle, says Bob. Those drawing conclusions from '08 about the need to cut fast today to avoid the risk of a precipitous drop in growth ahead are missing the big picture. '08 was the bursting of the greatest debt bubble in 100 years. This cycle is totally different, which I completely agree with. This is households and nonprofits. This is total liabilities, transactions, nominal, potential, gross domestic. So this is a huge move lower. And we're coming from a really low level, moving our way on upward. So yeah, it's not the same, guys. Not the same. And everybody using that as a comparison, I think, is I just don't think they know the markets that well. Here's memo. It says it can't be that simple. So similarly, it is obvious to us now that the market is likely too bearish on demand and far too bullish on supply projections for the oil market. That's his opinion. And I would tend to agree with it. Getting rich requires optimism, risk taking, and swing for the fences. Staying rich is a little pessimistic, skeptical, room for error, says Morgan Housel. And I would disagree with getting rich. I think that there's a way that people can grow wealth pretty dang quickly. And what that requires is you don't need to swing for the fences. You don't necessarily have to take on a bunch of risk. You do need optimism, though. This is what I would change this to. So, getting rich means that you adopt a strategy that is absolutely opposite of everyone else. So, what is opposite of everyone else? What do most people do? Most people chase performance. You cannot chase performance. You need to be patient. You cannot be impatient. So if you want to get rich, what you need to do is you need to find sectors that are out of favor, that are very low, and are completely undervalued. You need to be optimistic about them coming back into favor, and you need to be patient. You can take on a little bit more risk if you like, but you don't have to take on a bunch of risk. You don't need to go into speculative companies. You can go into cash flowing companies, buying them at the right time when they're undervalued, and then sitting in them and waiting for the market to come and swing back around where they come back into favor. That is how you can make a lot of money without taking on too much risk. Too much risk is chasing things, not being patient, and you're buying things because the price has gone up. I literally just described what crypto is. That is big risk taking because people are only buying it because they see the price going up and they want to get rich. They're not buying value. They're not buying something that's out of favor. And that's where your risk reward comes into play. They're taking on far too much risk and they're swinging for the fence, so to speak. Grady says the ratio chart shows how historically undervalued small and mid-sized commodity companies are versus the commodity index CRB, setting up a massive up move for small and mid-sized companies or commodity companies. Do not miss it. Called the phrase false breakout down here, now back above the blue line as expected. So this is where the value is. This is how you identify it. CDNX versus CRB, and this is the smaller Canadian commodity companies versus the commodity index. You buy when it's down and no one's looking. That doesn't mean that you're taking a swing for the fence, risk taking approach to getting rich. If this comes on back, which I think it will, you can make a buttload of money. And you're doing it without taking on a bunch of risks. So what I do is I take these ratios and I price a lot of things together, against each other. And then I find what is out of favor. And if I find the stuff that's out of favor, then I ask myself, what is it going to cost? What is it going to take? What did it take in history to cause us to revert to the mean or revert over to an overvalued state? And that's what I look for. Are the market conditions that cause everything to rotate back? Bullish trend, we've got an EIA crude inventory draw. The crude inventory draw was minus 1.6 million barrels. Cushing was 1.9, and we had a little bit of positive to make the 1.6. Freight futures, AM update, we had dry bulk up 1% for Capesize and Panamax. And we also had VLCC and Suezmax for tankers up 1%. Working their way on up, giving us those bigger dividends that we like. Exactly. I'm glad that you guys were reading my mind, even though you probably weren't. Cushing continues to draw. Look how low we are. So we had very low levels in 2014, 2018, 2022, 2023, and here we are back to very low Cushing, Oklahoma crude oil total stock data here. Very low levels. You know what can increase these levels? Higher prices of oil. That is correct. So I think that higher prices of oil are probably going to come soon. Every time we've come to this level, we have turned and went higher, which takes higher prices. Brady again with commodities. So if gold is a 6x from here at least, which is what he thinks, imagine where platinum would be if this ratio goes back to all-time highs, which I think it will. That for 4.5 years, that platinum will outperform gold and silver in this commodities bull market. So he thinks that platinum is going to outperform gold and silver in the commodity bull market. We are coming from incredibly low anomalous levels. Anomalous. So what does anomaly mean? It means that we have these one-off times in history where it gets this cheap. We had it in COVID of 2020, and we have it today for platinum versus gold, platinum versus silver, and it is also cheap against palladium and rhodium. So platinum could be the all-star performer here. Am I swinging for the fence with physical platinum? Am I risk-taking with physical platinum? No, I'm not. But you know what the upside is in this? It's absolutely huge. If gold is a 6x and we go back to these highs here, that's 563%. So what that means is that platinum will outperform gold by 6 times. Let's call it 6.5 times. If gold does a 6x from where we are at today, let's bust out the calculator, guys. We're at 2,500. And he thinks it's going to go 6x. So 2,500 times 6 is $15,000 gold. And that means that we would do times 6.5 for platinum. Is that even possible? I don't know. But that is a possibility. That is still on the table. What is your risk reward on a physical metal? Pretty dang low. If you don't know how to buy physical platinum, join the website. Mayday coupon code. Ask me how to buy it, where to get it the cheapest prices. If you find lower premiums and where we're getting it, well, you just saved your money anyway by finding out that information if you want to figure out how to buy this stuff. But yes, I'm massively playing this platinum in the physical metals. And if you know nothing about physical metals, let's say you know nothing, join up, ask me all a bunch of questions. Are bars better? Are rounds better? Are sovereign coins where American Eagle Platinum or Maple Leafs? Where's a good deal? What does it look like? I can share all of that information. Don't be afraid if you're trying to learn how to invest and you haven't worked with physical metals. I can teach you all that. A comparative inventory analysis for 9/18/24 weekly EIA data. Total commercial petroleum stocks, other oils, he's got an increase of 1.5 million barrels. I actually thought it draw down. Implied WTI fair value price of 78 or $8 to $9 undervalued. We're probably about $10 or $12 undervalued right now. That's probably where we're at if you use the EIA data. He has an okay, maybe put in, maybe that means a decline. Maybe that's it declined by 1.5%, maybe. But he says $8 or $9 undervalued. Another one with Grady. So this is GDXJ, the gold miner. So this is what is now started. The chart looks ready. The miners are gearing up. We'll go to all-time highs and way, way beyond. The market opportunity of a lifetime. This is GDXJ, gold miners, the monthly candles, 14-year linear chart. And this is just a big bull. And we're starting to break and move higher here. He says, we bought heavily here at the service. We've been buying too, quite heavily. What I did is I fine-tooth combed a whole bunch of different companies. I looked at a lot of charts. I have listened to some of their earnings quarterly calls. I've looked at their balance sheets, and I think I've sifted through what I think are some of the best companies. Some of the companies are well-known companies. Other ones are a little bit more unique. They are both gold and silver. I've got silver junior companies that are developers, and I think it is possible with some of the developers to do incredibly well. I am hoping from where I purchased it that maybe I can get many multiples above where I purchased. Now, I don't want to give an exact thing, but I'm hoping that I can easily cross the 10x mark. And I think there's a possibility that they could even maybe touch 50 to 100x or more. It's possible. I don't know where silver's necessarily going to end up, and that's a large factor of where some of these companies will ultimately go. And I don't think you're going to get that type of leverage going into ETFs. So you're going to, if you want to take the risk, I would take it now before it gets too much upside. And I know a lot of people that they're going to chase. They're going to chase price performance, and I get the early entry points, and I'm very patient. So I get the good entry points. I've been buying these bottoms for a little while, and then you just have to wait. Um, that is where I would change Morgan Housel's quote. It's not about getting rich, or at least getting great entry points. It requires a few things. It requires a lot of optimism. You cannot be pessimistic. You have to be optimistic. Risk taking, I wouldn't say it's necessarily risk taking. Yes, there is risk involved, definitely. But you want to take the risk. If you're going to take it at any point, you want to take it at the least risky time. So you can mitigate risk. So if you are going to take higher risk, do it in certain windows of opportunities where the risk is the lowest to take that risk. So it's not about taking high risk and swinging for the fence. It's about taking calculated risks when it's the best time to take them. And that is taking it when no one else is in it and no one else is looking. It's like you're a ninja in the background buying stocks when no one's looking. And they're all focused on stock, sectors A and B. And you're over there in C and D cleaning shop and taking whatever the heck you want because nobody wants it. That's how it works, in my opinion. Here is Kevin Bamborough. I'm not going to go through this necessarily. And he's talking about Bitcoin. He's taking digs at Bitcoin, and I just thought this was kind of interesting. Here is Barbell Financial. He says, I bought my house at 25 for $292,000. It's a 3-bed, 2.5 bath, and 2,000 square feet on 0.6 acres in the town I grew up in. 10 years later, I'm married. The house is worth $700,000, and we paid off the mortgage. Our first baby is now on the way. Should we ever move? Question mark. And I mean, that comes down to whatever the person's situation is. This is where I would move. I would move if I saw a deterioration in the neighborhood or a deterioration in the community where my kids also shared the school with, I'll say, neighborhoods or whatever that are deteriorating, where maybe I don't want my kids exposed to the kids that those families are bringing up. So that is something I'm very sensitive of. My kids are not only a reflection of myself and the values that I hold, but I also know that friends can have a heavy influence on my kids' life. So if I subject them to certain family types that go to a school that they are going to, I can kind of somewhat control the conditions that the kids grow up in. So that I would completely move if I bought a starter house in an area where the school system, it's not really the school system, it's the kids that grow up in the school system. And I would try to find kids that were similar to my kids and the viewpoint that is similar to the parents of what my viewpoint is. So that doesn't mean that you go to the ultra rich and the ultra wealthy neighborhood, get in that, and then go to some private boarding school or something. Maybe it is finding a really good public school in a very good area where the majority of kids are coming from families that I would say have very good values and ethics. So my kids would also adopt very good values and ethics from not only myself, but also from their friends, making what I'll say is better decisions than maybe other families and kids in I'll call it rougher areas, which may end up in jail or getting arrested or something like that, which I don't obviously wouldn't want. But I think that's an easier thing to do if you put the right conditions around your kids where they don't have to be subjected to that. So that's my opinion there. Finance guy says there's only a couple hundred houses for sale that we're looking for, and thousands of people trying to buy them. Every open house has lines of people out the door that have been waiting to see the home. Also, can we stop the you need to wait for open house to see the house nonsense? It only drives up competition. Wait, this is supposed to be a housing market crash, and this guy is trying to buy a house, and this is what he's experiencing. Now, not every city's like this, but there are a lot of cities that are like this. It is tough to buy a house at this time. He says, at first time homebuyer, how am I supposed to compete with people offering $50,000 to $100,000 over asking price? There's got to be something out there to level the playing field for us. The one thing I'll say is, I don't have an attitude like this. This is a reactionary like victim mentality. Guys, I don't have a victim mentality. I go out there and I get a realtor and say, look, what can I do to bypass half this crap? That's what I did. There are things and strategies that you can do. And you can look for certain things like maybe a house went under contract and then failed to actually materialize in a sale. Go hit that up. Go talk to realtors and say, hey, look, what are some buyers that backed out of homes? Because usually the seller's like, crap, I just want to get rid of this. There's some things already in motion and they just want to dump it. And you can get those homes. Maybe you need to talk to your realtor to talk to their realtor and say, what does it take to close this deal? Maybe there's a way that you can do it where you don't get a realtor. You go and look at the homes, and if they're doing a showing and you like the house, you can talk to the realtor and say, look, I'll go through you, get a discount for the seller, and then put in an offer where maybe there's some realtor fees that they can save on for the seller. There's ways that you can go around this if you're smart and you're tactful about it. Here's some other stuff. So Wyckoff distribution looks cleaner on the long-term chart. So this is the Wyckoff distribution. Distribution means you're selling. People are selling. And I just put the PSY, BC, and just put it right up on there. It even has the same fractal completely as that. This looks like distribution. If that's distribution, that's a topping pattern. That is a topping pattern. We could see a big move to the downside on this. That would also be analogous to a move lower in the NASDAQ. And that could also mean that we are going into a stagflationary environment where the market conditions allow this to play out like that. And that's where you want to be gold, silver, and potential energy, which also did very well during that time frame, that stagflationary environment. Because this is highly linked to the NASDAQ, and the NASDAQ could be rolling over. It could be. I don't know yet. It could be. And he says Wyckoff accumulation. This is not where you have accumulation. Here's Tavi. So inflation expectations appear to be showing real signs of bottoming after retesting their historical support, in my view. This perspective diverges significantly from the mainstream consensus and stands in stark contrast to the Fed's likely decision to begin cutting interest rates as early as tomorrow. In my opinion, now is not the time to take a bearish stance on commodities, especially cyclical ones like oil and copper, which typically benefit from the resurgence in inflation. Completely agree. And this is long-term inflation expectations, which is more or less just an oil chart. It's more or less an oil chart. And we're bottoming right now on this breakout. So I think it looks good for oil. I know. We could get a recession. I get it. I get it. But oil still doesn't look that bad. This is a good chart. Pretty solid. Most of investing is pretty boring. Buy, do nothing, buy, do nothing, buy, do nothing. However, if you keep at it, the boring actions become powerful results. That's pretty much it. That's pretty much investing. He summed it up pretty well. Imagine commuting 45 minutes each way just to sit in front of a computer for 8 hours a day. You know what? I started laughing at that um, because it's actually true. People commute. I was doing 20 minutes. And I'd sit at a desk and in front of a computer for a while. Yeah, it's completely true. Now, here's something pretty interesting here. I want to read this one through. At this stage in the business cycle, with financial conditions easing and fast, we're right in the middle of a classic setup where commodities are primed to move higher again soon, just as everyone else has turned mega bearish. Completely agree with this guy. Historically, it's in these moments of extreme pessimism, just as liquidity conditions start to rise and daily DeMark 13 buy signals begin flashing, that we see the big moves in commodity markets. Do you know why that is? Weaker dollar. The weaker dollar is driving it. Add to the tailwinds of a weakening dollar, there he is, and the stage is set for a rally. A weaker dollar doesn't just mean a lower DXY, it means global liquidity improves as dollar denominated debt becomes easier to service. So while people are focused on the headlines about a falling DXY, the real story is the ripple effect this has on global growth. He is right. Yes, China has been weak, but the PBOC is already injecting liquidity again, and we're seeing a notable improvement in the data on Chinese commodity container exports. As always, when financial conditions loosen, demand comes roaring back, and the markets tends to catch everyone off sides. This time is likely no different. I expect commodities to start doing well again soon, even as the crowd stays laser focused on the negatives. And what he's looking at here is the GMI financial conditions with a 10-month lead is heading higher. And this is the Bloomberg Commodity Index, which has a high correlation in following the GMI financial conditions. This looks fantastic setup here, guys. And here's the other one. This is the BCOM Index, which is starting to work its way on up, and maybe we can get a break higher here from a very low level. That's your commodity index. So that's what I am banking on here. This is part of it for a commodity move soon, hopefully. I just saw someone share they just locked in a 5.625% mortgage. I would not be surprised if real estate prices rocket. Correct? Correct. And that's where I'm going to end it, guys. That's what we've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys are interested in learning about commodities, what to look at, some of these companies that I really like. Sign up to the website, join our community, come onto the Discord channel, hit the question and answer sessions up. Watch my midweek updates. I've got all the companies. They're bolded out and the ones that I really like. You can look at all that. So that's what I've got. We'll catch you next time. This is Finding Value.